Hey there, students. My name is Nathan, and I am a Chegg tutor. Today we're going to be talking about how to calculate interest on a note. So first off, what is a note? Well, think about it as a company that's borrowing money from a bank or any other type of lender, where they're going to owe that money back plus interest. Now, interest I consider the cost of borrowing. So if you borrow $10,000, you don't just owe back that $10,000. You owe back 10 grand plus interest. So that's what we call the cost of borrowing. To borrow that 10 grand, you're going to have to pay a little extra on top of that 10 grand. Now, the interest rate is annual. So usually an interest rate is given when you borrow money from a lender. Now, to calculate the amount of interest on that note, and once again, a note is when you borrow money, you're issuing a liability saying, I'm going to owe that money back later on in the future plus interest. Now, notes, they can be current or long-term, so you can pay it back within 1 year or over 1 year. Now, to calculate interest on a note, here's a little formula here on the left side. Principal, which is the original amount of money that you borrowed, times your interest rate times time. Now, time is usually represented over 12 months because the interest rate is annual. 12 months is 1 year. So you have to take the amount of months that have passed and divide it by 12. That's a really important component of that equation. So once again, principal, the original money you borrowed, times the interest rate, times the amount of time that's passed. Now on the right side here, we're going to do a little problem just so you can learn how to calculate the interest. We're not going to worry too much about journal entries in this video, but I just want to show you how do you calculate the interest on a note. So, LifeWorks Inc. issues a $10,000 note on January 1st, 2015. This note has an interest rate of 5% and must be repaid January 1st, 2017. What interest expense must be recorded on December 31st, 2015? Well, looks like 1 year has passed. So this one's not too difficult. You take your principal times your interest rate times the time that's passed. So 10 grand times 0.05 for your interest. How much time has passed? Well, 12 months, and you divide it by 12. So essentially, it's just 10,000 times 5%. And you get $500. So that's your interest expense. Now, what if I said, what is the interest expense to be recorded on June 30th, 2015? So we would do 10,000 principal times your interest rate times the time that's passed. Now, how much time has passed from January 1st, 2015 to June 30th, 2015? How much time has passed? Well, if you do the math, it's going to be 6 months. 6 months have passed divided by the annual 12 months. So it's just going to be half of what you had before. $250 interest expense. Not too bad. Once again, you must use that formula, which will help you out here. Always keep track of the time from when you got the note originally to the date you got to record that interest. It's very important you keep track of the time. So of that formula over here, the time I'd say is the most important. And if you see a note that says maybe it matures in 3 months, all that means is that you have to pay it back the full amount in 3 months. That doesn't mean that's the amount of time that's passed. So again, focus on the time from when you got the note to when you have to record the interest. That's what's most important. Once again, my name is Nathan. I am a Chegg tutor. So you can visit me here at this link. If you need some homework help, exam prep, maybe just some one-on-one tutoring, just send me a message and I can help you out. Once again, thanks for listening today, and I'll see you in the next video.